the $1 Million Mortgage Experience podcast. All right, welcome to the podcast. Today we're on with Logan Mohtashami. He's an expert on the U.S. economy and real estate market. As lead analyst for HousingWire, he translates complex data into financial truth for housing economics. Welcome to the show, Logan.
It is wonderful to be here.
Well, I've been seeing you on CNBC and on some of my TikToks and Instagrams. I'm like, who is this guy? And so I was like, I gotta get him on my podcast, and I just wanted to have you on. So tell us a little bit about your story. How'd you get into economics?
This was a really strange accident. Our family's been in banking since the late 1950s, and my father opened up his own mortgage company in 1987, and I started to get in around 1996 and became an LO myself in 2003. But in 2010, a financial website called Benzinga, they saw me talking to some CNBC anchors about economics and politics, and then they said, "Do you want to be a political writer?" I was like, "Oh, hell no." But I will write about housing economics because I think there's some things that are going to be missed in this decade. So one thing led to another. With Twitter and everything, my work started to get a little bit more popular to the national media. I started to go on Bloomberg a few times. And then around like 2014, 15, I thought, you know what, let's do this the real way. Let's talk about housing economics and economics, how an analyst would do it, which means constant charting work. And from that point on, I just started to take it a little bit more serious. One thing led to another. And then, toward the end of 2019, HousingWire asked if I wanted to write maybe one or two articles. And I think what happened after 2020 is 2020 to 2024 has been so much of my economic focus in the past decade. So here it is. I'm ready. I'm excited to talk about this demographic push in housing. And then COVID happened. And everything was thrown in a loop. But I think what a lot of people know me for is on April 7th, 2020, I wrote a COVID-19 recovery model for the economic cycle and housing. And HousingWire at first were like, do we really need to publish this? You're actually saying we're going to recover in a few weeks. And by the end of the year, we say, oh yeah, follow this data line here, this date. Everything worked out. And then from that point on, more of the national media got the attention. And, I created the term forbearance crash bros in the summer of 2020. A bunch of professional YouTube grifters are saying housing was going to crash in 2021, showed work on why that wasn't going to happen. And we should be all afraid of home prices escalating out of control. And now, going on CNBC, touring the country, doing housing economic and presentations. So I'm like living my dream life. I feel like an NFL pro player that just got like $100 million contract. And they're paying me to, So that's how it all happened, just from one guy asking if I wanted to write in 2010.
Oh, that's cool. Yeah, it's a really cool thing to be able to. Well, definitely, you're resonating with what kind of my thoughts were when the 2020 happened. I immediately started looking and calling all of my real estate friends, saying, what's the listings? Are they going up? Or are there people listing their homes? Because I thought maybe, that would be the only way for the housing to crash, is because there was no inventory. We knew that. And it actually was the opposite. It was people didn't list their homes. They didn't want people coming through their houses during COVID. And so I was pretty early on during COVID saying there's not going to be any housing crash. And so when I heard you talking about that, I was like, wow, this guy, he knows his stuff. And it just sort of resonated. And I thought, like, this has got to be, there's got to be more to this. And one of the things that I end up doing is I post a lot on TikTok and Instagram, and people are always saying, the housing crash is coming and all this stuff. And I'm just like, well, how? How is there going to be a housing crash with no inventory, people paying cash for homes? And I just was like thinking to myself, I was like, the only way there's gonna be a housing crash if there's mass deaths or something terrible that happens, right? So tell me a little bit about kind of your overall, view on the health of the housing market today.
So much of my work is, inventory channels are run by credit channels, which at first might sound confusing, but if you look at my inventory charts, I draw these black lines, And I think one thing that a lot of people don't remember, in the year 2000 to 2005, inventory was rising and sales were rising. We had this massive credit sales boom. And I'm using the NAR data here. We were at 2 million active listings in 2000, but in 2005, we got to 2.5 million. And sales were booming. And then the credit boom bursted. And foreclosures were rising in 2005, 6, 7, and 8. All before the job loss recession. 2007 was actually the peak of inventory. A lot of people don't know that. We had 4 million active listings. But after qualified mortgage happened, we've had this slow downtrend in inventory for 13 years. So in this case, people have 30-year fixed mortgage, you have a fixed debt cost, your wages rise. So homeowners are doing really good. The notion that people would sell to be homeless would have to be the premise, right? Because you have your job, you're employed, you're making your payments, your cash flow is really good. So I always try to explain housing inventory that way and draw these lines and go, listen, this downtrend has been here for a while. So you get really tested when you have the biggest home sale crash ever. Last year, we went from 6.5 million to 4 million. And I kept on saying, hey, listen, inventory can grow, but there's limits to what it could do. And back in November 9th of last year, I talked about, okay, the housing market is about to structurally change. When rates fall, demand will stabilize. And even today, total active listings NER data is 1.1 million. I mean, we are far away from the 50-year average, let alone the peak of 2007. And the credit profiles of homeowners look good, let alone 42% of all homes don't have a mortgage.
Right. Yeah, that's
it's just one of these dynamics. You have to follow the credit data to understand why won't people sell their homes to be homeless, or why won't they sell their homes to go rent? And I always say that majority of all sellers are buyers, 75 to 82% of them. So supply is a function of demand. New listings data, something we track at HousingWire, was always trending at the lowest levels in 2021 and 2022. But after July of 2022, when rates got past 6%, we took another leg lower. And for 15 months now, new listings data has been trending at the lowest level ever recorded in history. So when the Airbnb bust or the housing, all these things, the new listings data never has confirmed it since the start of 2020. And I think our job at HousingWire is to show people the data so they can explain it better and take all the noise out of there, and it'll be easier to understand. And that's part of my job. I go from city to city and I do these 45-minute presentations, and the charts are designed to be entertaining, but also useful in the sense to where people could just explain them to their clients or to their fellow agents so everyone could understand it better. Because in a world now where data is so accessible, it's really how what you believe the data is trying to tell you.
Yeah, that's interesting. Yeah, I love your little graphs because it's just so obvious, when you see it that way. A lot of people go off of fear and feelings, and this they think that it's going to repeat. 08's going to repeat, but it's so fundamentally different with, like you said, QM, and even non-QM loans are so they still have ATR requirements.
Exactly. That's one of the things I had to explain to people in 2020, that the non-QM loan products are not the exotic loan debt structures that we saw, the 80/20s, IOs, the option arm loans. Right. A lot of the bank statement loans were actually really qualified people with a lot of equity. So I think the debt structures back then, all those loans went away. So people don't understand that, everything was legit. A job loss recession can create people selling, but even at that case, they're not foreclosures. Foreclosures were rising for 4 years before the job loss recession happened. Here, what we call is forced equity sellers, and equity levels are the highest level. So I could not put two different housing cycles next to each other in the history of economics on planet Earth than these two. And then hopefully by now that we're almost in Halloween, in 2023, people could understand how different and unique the housing cycle is.
Yeah. Now, you say you've been traveling from city to city. You had to have seen, Nashville and maybe Miami and all the cranes and all the buildings. I have a couple rental properties in Nashville. And one thing that just happened, which was interesting, and this could be just anecdotal, but the condo that I had listed for, it was like $3,000 a month. Now, a condo high rise just came on the market, and there's, a flood of inventory of 2 and 3 bedroom condos. So the price of my condo now has dropped almost in half as far as monthly rental, because they need, they're trying to get the supply rented. And so I see probably different pockets to where, rental properties might be kind of, affected, like maybe a Miami or a Nashville or, different things like that. What are your thoughts on that?
This is a topic near and dear to my heart. I remember kind of toward the end of 2020, I was talking to the Washington Post, and it said the history of global pandemics, they're actually very inflationary for rent. Just pandemics, the supplies of everything just doesn't work normal. Just like in world wars, you're almost in kind of a capital control state. But the disinflation factors actually do come true. The one thing that is different here is that we had an apartment boom in America. Multi-units or apartment construction under construction is still 1 million right now. I don't think they're all going to get finished, but we had an apartment boom, so we were going to have major supply. So I think last September in 2022, I went on CNBC on the CPI day, and I said, rent inflation lags on the CPI data, but it's going to be so apparent to everyone in 2023 because the growth rate of inflation is going to fall by itself because of shelter disinflation. But then the supply is going to come as well. So you're going to get hit on both sides. So the CPI data still lags that reality, but real-time rents you get to see. I mean, the history of rental deflation in America post World War II is very rare. We don't, because most people are working, but the growth rate in places, Nashville, Miami, there are places where it's actually negative now, just because the supply is finally hitting, the marketplace, and the supply and demand equilibrium for there is much different than the single family side. In fact, single family rentals are holding up better than 5-unit constructions in that sense. So we had an apartment boom like we haven't seen since the early 70s.
Right.
And then what happened in 1974, the recession there, the apartment construction boom collapsed. And we're in that process to where construction loans, running 6-7% made sense, but now at 13-14%, it doesn't. So you're getting people starting to pull the plug on things under construction, and the supply is going to hit. So that, in a sense, is good for disinflationary factors, which will be good for housing, because when that occurs, the Fed could lay off, rates could go down, but it's painfully slow.
Yeah. Do you think we'll see ever the condo conversion craze again?
City to city, and how that's going to work out. There's so many rules and regulations, and one of the questions I get across the country is, why don't places that have empty commercial buildings, why don't they just make them condos? And the coding just to convert them into condos just aren't there. So we don't even have a good story of how many can be converted. But there are places where you'll see condo conversions a lot more faster than others. But in terms of the commercial buildings, the coding, the building structures, they can't even fit them to be inhabited by living people. So the supply is going to come for the next 2 years, but eventually I think the production of apartments are going to slow down so fast that 2 years down the line, we might even see a supply constraint again. And that's how cycles work. You get these building booms, and then they bust, and then nobody builds for a few years, and then all of a sudden we're back here again where we need more supply.
So also, I've noticed in different, Airbnb pockets, you're going to have people who aren't getting as many many renters that are coming in for, whatever ski weeks or different winter months, or, different places aren't, filling up as much as they were because just the recession that we're kind of in. And what are your thoughts on, people who have those debt service coverage loans on the single family side and condos? There's a little bit of nervousness talk in the investor community, especially in the non-QM space, about we did a lot of these debt service loans, DSCRs, where we were going off, the Airbnb income to kind of qualify. And, I know they have historic equity in these homes, so I don't have any, worry that these homes are going to foreclose or necessarily default. But, do you see that that's going to maybe bring some uptick in homes that are going to be listed for sale in these
you're going to see people that probably didn't do their homework and get hit on the not bringing in the rents needed. Now, the Airbnb story is there's over 144 million total housing units in America. Airbnb is less than 1% of it. So it kind of went from like 800,000 to the boom is actually like almost at 1.2 million.
Interesting fact, 1%. Wow. I did not know that.
Just that hit you. So naturally, whenever you get more supply, the price of the product or the rent should go down. So there are areas where I think there's a lot of inexperienced people that just went into it thinking everyone's doing it, so I can make money. If you didn't do your homework or you didn't kind of have experience renting properties out, you're probably in a bind where you see the growth of Airbnb come in. I think that's a risk for that. But one of the things I've always said, a lot of people said this year was going to be the Airbnb bust years. Actually, they said the same thing in 2021 because nobody was traveling back then. But new listings data in America has been trending at the lowest levels ever recorded in history for 15 months. So if you're ever going to see like a bust where rental owners are going to start listing their homes just because they can't cover, we'll be able to catch it first because we get the new listings data updated every Friday. And I always write an article about it on Saturday just to let everybody know. And so far, nothing really. We've been trending at the lowest levels ever. Just last week, we're down week to week, down year over year. We are finding a bottom, a historical bottom in 2023. So there are pockets where people just didn't do enough homework and it's costing them more to keep it. Usually those people are going to be the first ones to sell because if they do have the equity in there, it makes better financial sense to unload the property. But we have not seen anything under any circumstances, actually, in the last 3 years to see any stressed inventory coming to the market.
It's so interesting. It's becoming harder, I think, for people to buy homes, but the people that own assets and own homes, so there's a separation. I think you can kind of see it with the rich and the poor, and it's an interesting, people who don't own and people who own. People have a lot of assets, a lot of homes or real estate, have created so much wealth over the last 5-6 years. And so, it's an interesting time.
Yeah. The 30-year fix, every city I go to, I just go, it's not fair in America that we have a 30-year fixed products. Other parts of the world hate us because they have so much short-term debt. There are people in Canada that are waking up to the morning, their mortgage payment is doubled. Right. There are a lot of these countries are tied to short-term ARM products. And we have a 30-year fix. So I always say fixed debt cost, rising wages. What happens during an inflationary period? It's been so long since we dealt with breakaway inflation, but your wages rise to compensate for the growth rate of inflation, but your debt payment stayed the same. And then people have been living in their homes longer and longer, right? From 1985 to 2007, the average housing tenure was 5 to 7 years. From 2008 to 2023, it's been 11 to 13 years. In parts of the US, it's 15 to 18 years. Wow. I mean, I've lived in my home for 20 years. So think about that fixed payment, your wages rise. 3 refinancing waves, 2012, 2016, 2020, 2021. So your total housing cost on top of the nested equity, that's this icing on the cake. But your total housing costs for your wages are so low. So as a homeowner, you are shielded not only against inflation to a degree, but you're also shielded against the Federal Reserve. So all these aggressive rate hikes and everything, the effective mortgage rate out there is so low. And, there's just not enough home sales to offset that. All these people have rates and total costs so much lower that it's, in that case, being a homeowner was the biggest advantage on planet Earth, but it was only in America that we have Freddie and Fannie, VA, FHA. We have our plumbing system is much different than other countries because other countries are not as lucky as us. So that advantage is not only just the nested equity, but the total cost of housing is so low. So it's one of the factors why new listings data has been trending at the lowest levels for 3 years. People are just doing good, and they don't want
to get rid of that 30-year fix.
I mean, they're just like, I have a $1,800 payment. It's $5,000 if I move. My cash flow is so great. And in a time like this where you're not sure where the economy is going, your house is the best thing on planet Earth, because not forget about the nested equity. That total cost is so much lower than actually a lot of people what they would rent for.
Right.
And that's the thing, is just that people's current wages, if you've just bought a house, if you're 26 or 27, it's different, but so many people have been living in their homes longer that their wages are so much higher than their original time they bought. And now with so many people refinanced, that the homeowners in America are like the last people on planet Earth anybody should worry about.
Yeah, I agree 100%. Let's talk about interest rates. I mean, as we know, we've had just insane hikes over the last 2 years. It's been very tough as a CEO of a mortgage company to navigate that. But it's kind of like balancing out. We kind of feel. I mean, I know there could be one more rate hike. What are your thoughts on what is that doing to the home prices? Is it affecting them at all? Have you seen any kind of impact on that, or what are your thoughts on it?
When we, obviously home prices escalate out of control, and that to me is more of a function of inventory breaking to all-time lows. We had 3.25% to 5% mortgage rates in the previous decade, and we didn't have out of control home prices because inventory was much higher back then. Here, as soon as rates got above 4-5%, the growth rate of home prices decelerated. Last year, for the first time in a while, we had month-to-month declines in home prices. And I would say that last year was such an abnormal year that we should almost X out 2022. We literally had the biggest crash in home sales ever. We had mortgage rates have 2% swings twice within a year. We had, from 3 to 5, and they got to 6, and 6 back to 5, from 5 to 7. That's not normal, right? So everybody that was in the marketplace, that had to sell, were like, okay, we have to cut some prices. But after kind of November, everything kind of stabilized. Home sales stopped crashing. And what's occurred is that during that period of time, home prices started to go up again, just because we're back to the low inventory, stable demand. So higher rates can create more days on the market. And we have, the price cut percentages that HousingWire, we show that every single week. 1/3 of all homes have price cuts in America all year long. But the price cut percentages, if things are getting weaker, we see that price cut percentage each week rise. And even today, with higher home prices and higher mortgage rates, the price cut percentage is actually still 4% below what we had last year. So last year was kind of like a once in a lifetime event, and we're not repeating it. And that's how I explain why prices are still firm. We're not growing home prices in any big fashion, and there's pockets of the US that are actually declining month to month. But in general, as long as you have stable demand and inventory low, it's hard to have like big national home price crashes, because there's not enough velocity of home selling, and to have owners cut their prices so fast to get out. So definitely rates matter, but the growth rate of pricing tends to cool. And the only time we saw real negative data lines was the second half of 2022. And we got to remember, after having rates go to 3 to 6%, we went back to 5 to 7.5. That second half of seasonal price, people were just cutting prices just to get their home sold. And that marketplace ended after November 9th. So it's a weird marketplace, but we keep it simple. Total active listings are still near all-time lows. New listings data is trending at all-time lows. There is no distressed sales of anything out there to matter. And that's why pricing has stayed firm. And kind of, we saw that even in the late 70s and 80s with even higher mortgage rates then. The only time we've ever had really big nominal home price crashes was, 2008. And all the variables that were there, none of them are here today. A much different marketplace.
Yeah, I mean, I remember there was zero down on investment properties, and there was even 125% mortgages. It's like, we have tons of equity in homes. I think historically, right? There's trillions in equity in the United States homes. So it's like you said, it's just a different market. 2008 to 2023, 2022, it's a totally different market.
I think that's a good point in saying that back then, a lot of investors had like 7 or 8 properties, and they also had option arm loans.
Yeah. Or just even 228s or 327s, right? Where like the option arm at least had equity in it, right? Like if you had an option arm, you had 20%, 25% down. Some of these 228s and 327s, they had literally zero equity in the home, and they had this adjustment.
Yeah, it got really crazy from 2002 to 2005. And we see it like in the mortgage availability credit index, it skyrocketed to 900, from 100 to 900 in 2005, and then it collapsed. And we've gone nowhere for like 13 years. But the exotic loan debt products that were facilitating demand were designed like ticking time bombs. So when you have not a lot of equity being created, and those things go off, you have this explosion of inventory. That's why my inventory charts are really designed to go back to 1982 to give people like perspective on how crazy 2000 to 2007 was, and how boring and slow the inventory channels have been after 2010. And you got tested with COVID, you had forbearance, you had 7% mortgage rates, you had the biggest home sale crash ever, and homeowners are staying chill because they got a boring vanilla 30-year fixed mortgage, and they're employed. And when you're employed and you're making your payments and your costs are low, you don't act like stock traders. I would say stock traders are the ones who panic all the time because they're always on margin, right? So they think homeowners are on margin. No, they're not. You're not getting a margin call in your house unless you're a Peloton CEO and have to owe Goldman Sachs money. So outside of that, everybody is just, as long as they're employed, everything's good.
That's good. Good stuff. Talk about the 10-year treasury and the inverted yield curve. It's kind of, I have my own theories on what's happening, but I just would love to hear your, it just seems like it just keeps ratcheting up. And is it that, people they don't want to buy these treasuries because they're just nervous? And I know the Fed's not buying. So talk to us about that.
So I have a 6 recession red flag model. I even presented that to the Federal Reserve in 2019. The conference board that created the IMF, the World Bank, I actually spoke to their trustees last year when I said, here's my 6 recession red flags, and the inverted yield curve is one of them. But traditionally speaking, toward the end of a cycle, bond yields actually do increase. And then when they do increase, what happens is real yields, like where the growth rate of inflation's at and the 10-year yield is at, it actually gets very restrictive because bond 10-year yields do increase kind of toward the end, because the economic cycle the data is still good enough. Here we have a lot of things happening at once. Number one, the Fed is quantitative tightening, right? They're rolling stuff off of their balance sheet. We have a lot of deficit spending right here coming in. So we have a lot of supply. So there's demand there, but then global bond yields are so much higher now. Like Japan they're not in negative territory anymore. So global bond yields work with the supply and demand imbalances, or how bond traders work from. So we have a lot of things that are pushing rates higher, but it somewhat looks normal as long as the economy is still moving. See, bond yields started to whiff out, they thought, a recession late last year going into 2023. The banking crisis drove the 10-year yield all the way down to kind of 3.24%. I've kind of said at the start of the year, we really shouldn't break under kind of 3.37% unless we're about to have a recession and the labor market's burning. So I believed in it so much, I called it my Gandalf line, you shall not pass. And it got tested 8 times. And I was like, my God, this is really like taking it to the next level. So what happened is, after the banking crisis was solved short term, jobless claims started to fall, bond yields rise. This looks like every kind of economic cycle, because right now we're really restrictive. Like the Fed was telling us that the monetary policy is restrictive now because the growth rate of inflation is falling. Back when we were running at 8-9% year over year, we were actually not very restrictive because the 10-year yield wasn't high. So we are at the spot that in every kind of economic cycle, the recession isn't that far off. This is why you've seen some of the Fed presidents in the last 2 weeks try to come online and talk the bond market down because the bond yields took off right when they were in kind of restrictive territory. So the Fed doesn't want to cut rates. But if jobless claims start to tick up, like my level is like 323,000. Once that happens, the labor market is broken. The 10-year yield is going to head lower by itself. And then the question is, does the Fed come in and follow every single cycle? So we've had, kind of a big push the last a few months, but One of the data lines that has gotten better is the one data line that I focused on this year. Jobless claims was trending up higher, and it's kind of reversed course. Job openings are still above 9 million. So the labor market is just holding up better than a lot of people thought. But we do usually see yields rise toward the end of an expansion. So the inverted yield curve, giving it up at this point, actually runs with normal economic cycles. It's just that usually the Fed is cutting rates right about now. Usually after the last Fed rate hike, bonds rally because they're sniffing out a recession. Here we have a lot of deficit spending that's keeping the economy moving. So it's different in that light, because there's a lot of people that are going, why isn't the bond market rallying and yields going down with the last Fed rate hike? There are a lot of different variables that play in this cycle that's a little bit different than the previous ones. But traditionally, we should see the 10-year yield rallying. So one of the things I'm talking about for 2024, it's a better backdrop for bond markets to rally and mortgage rates to go down next year than it was this year. We'll see how, we track all economic data every single day, every single week. But next year has a better backdrop for that, for the 10-year yield to fall. And of course, getting to 5% made it really restrictive on Fed policy.
Mm-hmm. I wanted to talk a little bit about de-dollarization in the BRICS countries and how that could affect the yield and Treasury. Is there anything you have on that? Because I know the dollar's strong, right? I mean, we have a real strong dollar. It's been getting stronger against a lot of currencies, but you keep hearing this BRICS and the people China dumping dollars, and so I'm just curious what your thoughts are.
The problem we have in America is the dollar's too strong. Yeah, it's always been, we have such an unfair advantage over the world. So we've got the biggest economy. We have really good demographics compared to other people. Like Japan's dying, 40% of their population will be dead by the end of the century. Europe's demographics are falling apart in terms of their population growth for younger people. Japan hit their peak limit in 2015. So we have good demographics. We have the biggest economy. We're the wealthiest country in the world. Maybe Cleopatra, back in her days adjusting to inflation, was wealthier than America. But we have that. We have friendly neighbors. We have two oceans that separate us. We have the biggest military. It is not fair, the advantage the U.S. has. But the problem with that is that our dollar gets really strong when there's drama around the world. And the world can't handle a dollar being too strong. It causes chaos. Last year, the summer of last year, the dollar is getting stronger. And God, London was going to lose its pension funds. They almost didn't even open the stock market there because they were going to wipe out all their pension funds. Japan always has to do intervention when our dollar gets stronger. So the BRICS, Russia, Brazil, China, India. Out of all those countries, India has the most potential, but nothing's going to happen. These are like four drunken people trying to hold everything up at the bar. It's funny because nobody talks about the euro getting really weaker. They try to make these stories that the dollar is going to get weaker. It's just our issue has always been the dollar gets too strong and it creates havoc around the world. So they need to do something to alleviate that. And I think in Russia's case, especially when they get sanctions, they have to find a way to make their economy work by exporting stuff. Brazil, of course, exports a lot of food around the world. And China is dealing with a lot of issues that, we saw this in Japan in the 1990s when their population growth for prime age labor force peaked, and then it started to go lower. So they have so many homes that nobody's living in them out there, and they're so used to real estate helping their economy out. It's just not the case anymore. So their kind of state capitalism has growing pains. So if anything, I wish the dollar wasn't as strong, but it's just the U.S. has such an unfair advantage over the world, and in this case, the dollar getting too strong is just the world can't handle it. And I'm hoping that the dollar my running joke was that the dollar got to 115. I'm going to be the dollar for Halloween, because that's just it's a global wrecking ball, like it was last year. So we can use the dollar not being as strong, but those countries, there's some nefarious reasons they need to create their a new currency. But to me, it gets interesting with them if they try to do a commodities war, because it's so much of food and energy, and they can control some of that stuff. But I'm like the last person who's going to say, the last thing I'm worried about is the dollar collapsing in any fashion or anything in that matter. And the dollar actually going lower would actually be good for rates, but the dollar getting stronger and then forcing other countries to sell treasuries to protect their currencies, that tends to be a problem for mortgage rates in the short term.
Good points there. What are your thoughts on, I know things are heating up in the Middle East, and we're starting to see a lot more headlines that are, clickbait or whatever you want to say it. Some of it's obviously real. And there's some scary stuff out there. How do you think that would affect the interest rates if we ended up in some kind of war with Iran or within the Middle East? I know we're sending troops. I know there's a lot of stuff going on that, people can see in the news, but what are your thoughts on that?
Usually people would run to our dollar and treasuries whenever there's a kind of a world chaos. And so far what I've seen is the dollar really hasn't rallied, and the bond market has not really acted with all the drama out there. So the market right now is not smelling any escalation. Escalation is not good for anyone.
Right,
We've had a lot of skirmishes in the Middle East over the last 10 or 15 years. They haven't escalated yet to other forces coming in and creating that, because it's not to anyone's interest over there. But as of right now, I just haven't seen the rush to the dollar or the rush to treasuries that you would see in any kind of conflict that people are mindful for. So as of right now, the market is saying it's somewhat contained, but who knows? We're dealing with a time that you just don't know what other parties could come in and try something. But
would that be like an indicator just to kind of see? Would it be an indicator to see some of that stuff rising to just kind of tell you the market's kind of nervous about it? Or
if the market was nervous, people would run to our dollars and our treasuries, because that's the safest bet in the world. So bond yields would go down, the dollar would go up, mortgage rates would go down in that sense. And quite haven't seen that action yet. And I literally have the dollar on and the 10-year yield on my brain all the time. So it's just there hasn't been that rush to safety yet. And I think a lot of that is, they're trying to free some hostages and holding stuff back. So we haven't seen the full impact of what's going to happen in the future. So that's kind of what I look for, because usually the dollar would rally, get stronger, and people would buy treasuries in the US. Not the case yet, but it's something we always keep an eye on every single day, because anything that happens on the news wire, we get to see that. But that would be the market trade on something like that.
Interesting. We'll be watching that then, because there's a lot of saber rattling or whatever, just news like clickbait going on. And I think I listened to a Elon Musk and David Sachs podcast yesterday where they're all talking about, are we headed to World War III? And I was like, wow.
You know what I do? I don't watch TV outside of football or sports. I hardly follow anyone on Twitter. And I don't even, I just focus on my work, because the thing now is with social media and the advent, the system is designed to work with your head with really crazy headlines, because that's going to entice people to listen. And I think part of the thing about, being an analyst, if you let your ideological takes go into what you think the economic takes is, you could be doing a disservice to your readers in a sense, because you want to believe what your own fundamental beliefs are rather than what the economic data is. And it's just, there's so much noise there that I've the last few years, I don't even watch my own interviews on CNBC, and I just I got to see it on YouTube. But Twitter, I follow like maybe 200 people. And it's just, in this day and age, there's so much attention drawn to just a headline that really might not even have anything to do with it. And that's how the system has worked. It's to get you to engage, or if it bleeds, it leads, right. Kind of stuff.
Looking for attention, looking for eyeballs, however they get your attention.
My running joke is like the most popular thing I ever wrote in 2017 on April Fools. I said the U.S. is going into a recession. And I wrote all these things of all the reasons everyone said the US is going into a recession. And then I wrote all the things that is not true. And then at the bottom of it, I said, if you shared this article without reading it, because it was an April Fool's joke, then you're the person I'm talking to. And I still trick people with that just because of the headline. And there's like one guy that's been tricked 3 different times, by the same article. So it's just yellow journalism. That's just the world we live in. And just for myself, I always say politics is the word itself. Politics, many blood-sucking parasites. So you got to keep things with just numbers and stay away from the noise. And this is why, I'll follow the data, and I'll if anything news-wise comes that's big. But man, with the cast of characters we have in this world now, boy, things could get really wacky on the news front. And I try to stay away. I try to avoid myself from that, because I think you got to focus on the numbers and stuff, and then not get caught into the madness of the world. It is, because information is like this. I mean, look at what happened with the bank runs. Silicon Valley Bank. Geez, that was like 3 Slack messages and boom, goodbye. Boom. There goes that money. So the world the information moves so fast these days.
And a lot of misinformation, disinformation. Yeah.
Disinformation. That's the thing. So one of the things I've done, and I started doing this 18 months ago, there are so many trolling bubble crash people out there that I challenge them to live debates. I literally take the Build a Butcher gift and just go, let's go one-on-one. And I try to get people on a debate. Now, so far, everyone's kind of wised up to my acts, because as soon as I get them on a live debate, I'm going to destroy them. But I've gotten a few stock traders to fall in. And then once people can hear these people talk, you could realize, wow, they don't really know what they're talking about.
Yeah.
They don't forecast. They have no models. They just, everything is doom and gloom. This way, I've done this for so long that people have actually stopped trying to engage me, because all I do is, okay, let's have a live debate. Let's have a live debate. Let's have a live debate. So correct information is the best way to fight disinformation. But disinformation gets all the volume. So people like myself, we're like pilgrims in an unholy land. We're like the old guy in a dungeon, the long beard and a candle, and we're reading scrolls, and they bring us out once in a while. So, but in this way, to kind of attack disinformation is you get people into a conversation, and then when they have to talk, this is my debating tactic. I just let them talk, and then I'll ask this question, and then you can see they're just not data people. But outside of that, you could get so much bad information out there, and that's the business model. The worse it is, the better it is for a lot of people.
So true. Good advice. Turn off the news. Just get back to real life and data, like you said. Back to some numbers. I used to look back during the crash in 2008. I looked at the U.S. debt clock a lot, because I was in the foreclosure business. I did a whole bunch of stuff with that, and I would see the ticker, the U.S. debt clock. Now it says we're at 33 trillion and rising by the day, and with these interest rates and the debt's going to have to be paid at these higher rates at some point. How are we going to do that? How is that going to affect our economy? What are your thoughts on that with the debt?
In 2019, I wrote an article, 71 trillion in debt by 2060. And I said,
probably beat us. We're going to beat the number.
Yeah. And that was a conservative number. That was before COVID. And I said that there is literally no way we're paying the debt. This debt is going to be monetized, and it's going to just keep on growing. Just the laws of demographics. We have so many older people coming into the system,
right,
that mandatory payouts are the majority of the debt expansion. And no one's going to cut Social Security. No one's going to cut Medicare. No one's going to cut defensive spending. No one's going to raise taxes.
Right.
It's all this gambit. So what's occurred right now is that the interest of the debt has gone up because rates have gone up. But also, I think one thing that people forget is that the government is a net payer of that interest out to people. So investors actually have a lot of interest income now. There are companies out there that are actually making probably the most money on their cash in their accounts, because they're not profitable yet. So one person's debt is another man's interest income. So there are some benefits to that. To me, like Japan's debt to GDP is like 275 or something. There's no way we're stopping this debt train unless you have like a Logan's Run at age like 40 back, when people are getting killed when they're 21 or something. You just have way too many people going to collect Social Security and Medicare. So the debt's going to keep on growing and growing and growing. But the one thing is that the United States of America is like, again, the biggest economy, biggest military, everything. So we don't have to worry about a debt blow up. I always tell people this: when Japan has a debt blow up, when the euro has a debt blow up, when China has a debt blow up, or any of these other countries, when their debt starts blowing up on them, or I always say if Greece, like the 10-year yield in America is higher than Greece right now, so if those countries start blowing up and their debt blows up, then we can talk about the US. But the US right now is King Godzilla, right? So the bond market will always give it its due, and the appetite for us, our bonds, like if the Fed wanted to, they could just go, okay, we're done with QT, we're going to start buying treasuries again. The 10-year yield would be at 3.25 within 3 weeks. They can do that if they wanted to. The Bank of Japan has been doing that for a long time. So it's a confusing topic because for so many decades, people say America's broke. We're like $195 trillion economy out here. Like, we are the wealthiest country in the world. Other countries that have to have debt blowups first, but there's nothing stopping this trade. And still today, the growth rate of inflation is falling, and our debt's not going to get treated like other countries. I mean, this is why the euro was created, because those countries did not want to go against the dollar on their own, so they created the euro as a whole. So it's always a confusing topic, but I always say that we're king dollar, king economy for a reason. So our debt's going to grow. Mandatory payouts are going to be extreme for the next 7 or 8 decades. And then eventually the population boom that we had last century, so many people are going to start dying around the world. And the demographic things are just going to change. Like everyone's going to become Japan at some point. But Japan's population is going to be dead, 40% of it by the end of this century. So their debt to GDP is so much higher, but they're borrowing at much lower rates than us. So I wouldn't worry about the debt in that sense, but definitely the politics around debt is actually more interesting if they actually try to balance or do something like that or raise taxes. But in that article, I kind of highlight all these things people talk about. Nothing ever gets done because
they keep raising the debt ceiling and it just doesn't. Nothing ever ends.
They're just, no, it's not. Yeah. I mean, if the bond market is the only people that could actually regulate the government spending, and the 10-year yield is, considering where inflation and growth is, it's actually pretty normal. And if you look at the history, like if I took a bond chart for 800 years, it's been in a downtrend, right? It's very, the 70s were very abnormal, but we had labor force growth. The baby boomers were coming in. Oil adjusting to inflation today would have to be $450 for the oil prices back then. So we had a lot of different things back then. But if you take the 70s out of it, the 10-year yield's kind of like 5-3% has been normal, going back to 1790. So you get some bond market rifts here or there, but yeah, the debt's going to keep on growing, and nobody's ever going to do anything about it because that's the political thing. Nobody's going to cut Social Security because all the people that we have now, the baby boomers, nobody's going to do it to them, and Medicare, and nobody's going to cut defensive spending and raising taxes in this country. That's never going to happen either.
California, they've been kind of raising taxes over here, but
California, that's a whole different. California's a whole different subject.
That's a whole different subject. So you don't think the Fed's lost control by any means or anything? I mean, what would take?
I think the Federal Reserve is probably a little bit happy that bond yields have gone up so it could stay restrictive so they don't have to hike anymore. But I think this last move has made them a little bit leery. Again, if the Fed wanted to, 2 sentences, we're done hiking, we're stopping QT, and we want to support the bond market, everything changes.
Yeah.
If they wanted to have like a soft landing for sure, they would say that now. So they're kind of afraid of the 1970s inflation, which is funny to me because this is just straight out of global pandemics history. So they kind of said we can never have inflation go down or the growth rate fall unless the labor market supply. Well, guess what? We have 5% growth GDP this quarter, and the jobless claims is under 200,000, and the growth rate of inflation has been falling for some time. So there's a history of global pandemics, especially 1918 to 1920, where you see these major inflationary periods and then a disinflation period. So here it's gone a little bit faster. And now all the rental supply is coming to hit the markets, and 44% of CPI inflation is shelter inflation. 25% of that is rent.
So that'll bring it down pretty rapidly, right? I mean, with all this, the rental market kind of softening there, that's what I'm seeing. As a landlord, I'm seeing it firsthand. So I imagine that's going to really, once that data hits, it's going to really sort of bring that inflation down.
I mean, and they kind of know this to a degree, but it's just the Fed is worried about their reputation, and they literally told everyone we're going into a recession this year, and that's the only way to bring down inflation. So they kind of put their heads down, and all of a sudden they're like, oh wow, the labor market is resilient, everything is resilient. Well, guess what? Everyone has 30-year fixed mortgages, right? Raise the rates all you want, the fixed debt costs. And that's one of the parts of the presentations I give when I tour the country is I show people the credit debt profiles in America. I say, guys, look at how beautiful this chart is. This is like one of the sexiest charts I've ever seen. And I just get so happy. Other countries would die to have this. And it's just a simple thing is that, our debt costs as a percentage of our income is so low because everyone's got 30-year fixes, and majority of all consumer debt is mortgage debt. And we put everybody in a really good spot the last 12 years. And when COVID happened and then inflation happened, a lot of American families were shielded where other countries don't have that luxury.
Well, that 30-year fix is the gift that keeps on giving. And it's also been the death of the loan originator because they got all their clients into these amazing loans. And now the clients are like, I'm good.
It's one of those things where we haven't dealt with breakaway inflation for so long. So every single housing cycle since 1981 is at 2% plus lower rates to help, demand and refinances. And for that to happen again, we'd have to have mortgage rates get down to 0.5% because, we got to like 2.75 or 2.5. But what's occurred right now is that rates have gone up so much, and it's gone up with duration that next time when rates do fall, not only do you get a little bit of the purchase boost, but you're going to have a supply of 4 to 8 million homeowners that do actually have higher rates. It's not going to be like it was in the past where we worked off of a channel of 3.25% to 5% mortgage rates, but we're creating more supply of homeowners that could refinance every single month with rates this high. And unless we never have a recession ever again, eventually rates do fall. That's how it's worked for every cycle. We're not seeing breakaway inflation. The Fed is being way too over aggressive now for no reason. And things will turn around in that sense. We just need to see the labor market soften up a bit.
So what do you think that it'll take the Fed to say those three sentences that you said earlier? Like
my Fed, because I've not been a Fed pivot person this entire time. I said, until jobless claims break over 323,000 on the 4-week moving average, and I won't bore you with my models on labor markets about that number, but that number breaks the labor market. The bond market would get ahead of the Fed, and the Fed would have to play catch up. I always say the Fed is old and slow. That's what they're known for, and they will be old and slow again. And they're doing it again. They're just like there was no reason for them to be so hawkish in the last Fed meeting. I was like, what are you guys doing? At this point, now you're going to be hawkish on the Fed. So,
right.
It was so annoying. They could have just taken the victory and just let it. They can't. And I've had a sense of this going all the way back to last year that they really, if they're doing 1970 model economics, boy, they really want a job loss recession because that's how you defeat inflation. And they whiffed on that, and the growth rate of inflation has already kind of fallen down, and the labor market's tight, and they still didn't learn their lesson because they still were hawkish. But 323,000 on the 4-week moving average, jobless claims are around 200,000. The bond market will get ahead of the Fed, and then after that, that to me is when the Fed starts changing their language and everything. But in that case, they're going to be old and slow again, behind the curve, and that's the history a Fed. I mean, this is an institution that meets every like 6 weeks, so they're not like on the spot unless you have some crazy event like COVID where they just do emergency rate cuts or something to that nature.
Well, you made me feel better. Got a lot of positive stuff. What do you think the biggest challenge in the U.S. is right now?
Well, number one, productivity sucks, and if we had productivity growth, that would be the Fed's like fantasy dream. And they always talk about they want wage growth to be kind of around 3 to 3.5%, with inflation being down there, be fine with that. But if we could get any kind of productivity growth, like one of the things that is really hurtful on housing, we literally still build homes like we built homes 50 years ago.
Yeah.
Like we have hammers and nails and everything, and I know there's 3D printing and everything, but construction productivity is the worst, So if we can get productivity growth in the US, it really would help us. And also, our advantage still is that the millennials and Gen Z combined are bigger than the population of Japan. But there's parts of the US that doesn't have a lot of prime age labor force growth. They don't have a lot of young people. So those areas are getting hit. Like one of the things I talked about early in the COVID-19 recovery, I was like, job openings are going to get to 10 million. And it was like, there's no way. And we just had a big miss on the jobs report. And I was like, no, I'm doubling and tripling down. I couldn't even get the BLS people I knew that, no, job openings are going to get 10 million really soon, because job openings have been slowly rising for a long time. Remember, the baby boomers are leaving the workforce. They have to be replaced. And then if demand grows, you need more labor. There's parts of the area that just lack young workers. And it just gets harder and harder for people to find work. And then, you have to pay up more. There's where productivity could help. So the lack of population growth in some areas and the lack of productivity growth to me are kind of a concern. And also housing inflation. The housing crash, like other countries are so much more expensive than us, like Canada, even France, the UK, Sweden, Australia, New Zealand. Their home prices accelerated so much more than ours because we had the housing bubble crash. We had a credit boom and credit bust. So we're just kind of catching up to a lot of countries, but we're so far away from them. So the housing inflation could be more sticky than people think. And that's a very difficult problem to solve, because if you have productivity and more affordable housing, you can make life easier for people. So housing inflation, productivity, and the lack of population growth in certain areas of the U.S. to me are more of a concern. The rest are in good spot compared to other countries.
Interesting. So advice for mortgage brokers. I mean, a lot of mortgage brokers are just hanging on, right? They're just got their one or two deals here and there. Things were so easy, money was flowing, and now it's like, they're just looking in the bottom drawer for that one borrower that, has got all the warts on it. And so, I mean, what are your advice for mortgage brokers that are just hanging in there and just trying to make it through this rate situation?
It's a very difficult time because the capacity of the mortgage industry really grew. And the technologies and the ability for competition grew. You always have to run your finances thinking about a kind of a boom and bust cycle.
Feast or famine.
Yeah, always the advice is that you have to realize you're in an industry that you can lose 50 to 75% of your income in 1 year. It has nothing to do with you being a good loan officer or not. It is the ability of rates, what we call the kill rates for refinances. And then if rates go up, the purchase market goes down. So the thing about now is, boy, this is the kind of the bottom you could imagine. I mean, home sales historically after 1996 don't really trend under 4 million. We're kind of just a little bit under there right now. And of course, the refinance market is dead in the sense you do get some people that do cash out because, their total payments would be less even with a higher mortgage rate. But we are kind of at the bottom trough of where demand can be. So you yourself have to know your finances and realize that at some point in the future, there is going to be more business, but always remember that you're in a sector that could go like this higher, go like this lower. True. And always kind of plan for that either way going in the future, because I think the inexperienced loan officers who just think I'll always have this much amount of business, have not seen these rate cycles and what they can do. And the industry just has so much more competition now, especially when some of these companies went public. You really the bottom line matters more than if they weren't public. So it's just been a brutal deep recession in the real estate industry, especially in the mortgage. And I think we have 345,000 loan officers, in the country. That number is probably a little bit inflated right now. So it's tough out there. The only thing I can say is that we're historically at very low levels of sales. We've had the biggest mortgage rate spike in recent history. So a lot of that bad news is kind of in. And the labor market's softening up a bit. Things should be better next year. I didn't think this year was going to be the year. I wouldn't have brought the Gandalf line out if I thought that would be the case. But next year should be a little bit better on the rate side. And since you're working from such low levels, you'll see an uptick in business in that sense.
It's good. Yeah. I think they're feeling it. And I think if they can hold on and find deals, do non-QM, do second mortgages like we talked about earlier, they could potentially keep themselves afloat. But it's always good to have that savings and that nest egg, and hold on for a brighter future, right?
Mm-hmm. Yeah, it's a feast or famine industry. So we've seen a few cycles here and there.
Any shout outs that people have helped you along the way to get where you are?
Well, number one, always to my high school basketball coach, Coach Keith, who taught me that you have to class, intensity, and teamwork. And that's kind of how I was actually going to be a history teacher and coach high school basketball. That was my whole game plan in the 1990s. He taught me that how you conduct yourself is how everyone's going to look at you around the world. And if you have a bigger stage, that means you have more responsibility. So I always give a shout out to him because I've used that principle, especially in my writing and economics work. And that's why I love going out touring and trying to explain to people, like a high school basketball coach. I mean, I'm basically like out there, like, drawing plays. That's kind of how I look at my charts. And that foundation is always rooted in everything I try to do out there, and always making sure every single presentation, every single podcast, the intensity is always there. So you have to think about every effort has to be the same, and you have to give it your best.
That's awesome. So we're lots of amazing information. I appreciate you sharing. Where does someone find you online? They want to follow you?
So we have a few avenues. Number one, HousingWire. If you go to the website, all my articles are HousingWire Plus. If you wanted to use the Logan VIP 20, that gives you the code to get access. We have a weekly tracker article that gives everyone the live inventory, new listings data, 10-year yield channels, mortgage purchase apps. We try to teach people the economics of housing on a weekly basis, because if you wait for the sales data, you're like 2-3 months behind.
Right.
That's where my information work is. We actually do have a top 10 Apple business podcast, HousingWire Daily. Sarah Wheeler and myself, we come on Thursdays and Mondays. And we talk about everything that goes on in the world, not just for real estate, but for the economics. And if you really want to nerd out, you follow my Instagram, and my Instagram stories are not fun partying or anything. They're literally just economic charts and going over bond markets and real estate information.
But you keep it fun. You keep it light and fun. Yeah.
And then on Twitter, if you really want to see me go after the housing bubble boys and crazy stock traders, Twitter, there's a lot of information there. So Twitter, Instagram, HousingWire, and HousingWire Daily, the podcast. Those are the best avenues to follow me.
And we will post a link to some of your stuff too when we post the podcast. Awesome. Well, thanks for joining us. Appreciate you coming on.
My pleasure.
Awesome. Thanks for watching, everyone. Please like, share, subscribe, and make sure you comment below and let us know any guests you'd like to have on. Thanks for watching.
The $1 Million Mortgage Experience Podcast.